Hi everyone, welcome to our fourth quarterly call for 2015. We have muted all the phone lines and Peter O'Keefe and Justin Stevens have the microphone. This call is being recorded and will be available for replay by visiting www.sageready.com and clicking on any of the O'Keefe and Stevens team members' profiles, then selecting Resource page. Before we get started, we must remind you that the purpose of today's call is educational and that the material presented is publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. This call is available for replay on the O'Keefe and Stevens resource page, which can be found on the Sage Ready website. Please contact us if you would like a link to the recording of the call or any previous calls.
Thank you, Carly. During our call today, we plan to follow the same format that we have on each of the previous calls. I'm going to start with an overall economic update and discuss the most recent quarter. Peter is going to cover our investment process and answer some specific questions that have come in recently about where we get our information and how we do our research. I'm going to provide an update on the new budget bill and its implications that it has on financial planning for your future. And we're going to wrap up the call with a review of 4 companies that you may own in your portfolio as either individual stock holdings or holdings within a mutual fund. We'll then stop the recording and spend time to answer your questions if there are any. If you do have any questions that come up during the call, you can type them into the question field on the GoToMeeting application, and we'll address those questions first. So for our economic updates, we felt it was most appropriate to address the recent volatility in the market. A number of clients contacted us after receiving the August and September statements. The broad market, measured by the S&P 500, hit a year-to-date low on August 25th, and then tried those low levels again on September 28th, conveniently right before the month end when we take a snapshot of your account values for your monthly statement. What you should be seeing as you receive your October statement is that numbers are back up considerably in October, so the questions have been rolling in and are basically all the same question, which is, why was everything down? So if we look to financial journalism, we're getting a confusing array of answers ranging from a slowdown in the growth of China, an anticipation of rising rates, a continued drop in the price of oil, and the list of rationale for the change of prices goes on and on. But we've had enough of the cause and effect approach to make sense of market moves. So I'm going to share with you the only true reason why stock prices change, and it's surprisingly simple. Stocks go down when more people are selling than buying, and stocks go up when more people are buying than selling. That's it. There's no other reason for a change in price, and the market is responding to buyers and sellers' demands, and the price adjusts accordingly. So stop applying a cause and effect. There is no other reason. Financial journalism has brilliantly perpetuated this short-termism through their cause and effect style because they're focused on one thing and one thing only, which is keeping you tuned into their story. Fear drives viewership and a lingering feeling that I need to figure this out, but is it really important to you? And I contend in this situation it's not. So we need to ask a better question. Where is the Dow going to be 20 years from now? So think about that. At just shy of 18,000 today, on Tuesday, November 10th, the Dow Jones Industrial Average, which is a weighted compilation of 30 companies, which is designed to represent the broader U.S. economy, is it likely to be trading at a higher price or a lower price 20 years from now? Peter, I'm going to ask you, in 35 years as an advisor, has anyone ever suspected that the answer is less than where it is now?
Not that I'm aware of.
Of course not, because it's kind of ludicrous to think that it would be lower. Most of the people tuning into this call have at least a 20-year time horizon. If you don't, we need to talk offline, but the vast majority of investors shouldn't concern themselves with the day-to-day, the month-to-month, or even the year-to-year gyrations in the market. It just doesn't help. It's an exercise in futility. So what is the point? I recently read a Nick Murray article that I think hit the nail on the head as to what our purpose as your advisor is. And so I borrowed a couple of his points to share a perspective on our role as your advisor. As your advisors, we have a duty to share our perspective with you as a client because we're acting as stewards to your wealth. So rather than focusing on market outlook, we really need to focus in investment philosophy. That's why we write our own newsletter and conduct these quarterly calls. So to the extent that we can educate you on our philosophy and get your buy-in to a long-term investment plan, we know you will experience success far greater than the average investor who's concerned only with market outlook. The person who hems and haws at the slightest sign of volatility and who's left to his emotions to dictate his investments. It's not different this time, and this too shall pass. History is the only evidence we have to support this thesis, and it's telling us a consistent story. This is not to say that each period of volatility in the market will look and cause us to feel the same as previous periods, because if it were that predictable, we'd be able to eradicate the volatility. It's not predictable, but it is manageable when you have a well thought out financial plan funded with a well thought out investment plan. And finally, I've been adding this statement for color to nearly all of my phone conversations and every meeting that I've had in the last few weeks. Volatility is the price we pay for the equity return premium. If we're going to take on more risk, also known as volatility, we should be compensated for the risk through an enhanced return. We simply wouldn't sign up for volatility if there was not a potential for a higher return than someone who experienced no volatility. Our philosophy of ownership of financially strong companies purchased at discount prices that are being managed to compound shareholder wealth are aimed at not only narrowing the outlying risks of going out of business or rising interest rate environments, but we're never attempting to eliminate that volatility because we know it's a crucial component of a higher long-term rate of return in your portfolio. So for the last slide on economic updates, I thought I'd share a chart that I think paints a pretty compelling picture of this volatility and how long-term investors really have benefited enormously from it over the last 60 years. I borrowed this chart from Rick Edelman, who promotes his company, Edelman Financial Services, through a variety of mediums, namely his radio show and podcast. It's a chart that illustrates the duration and size of the advances in the S&P 500, and it's softened a little bit by the effects of dividends that were paid during these time periods. But the red line illustrates the duration and the size of the declines in the S&P 500. You could call these bull markets and bear markets, and the green line is the run-ups following those red periods of decline. If you add up the red lines, you see that the S&P 500 experienced 12 bear market declines over the last 60 years, ranging from just a 14% drop over 35 months, starting in August 1959 through June of 1962, all the way to a much more punctuated drop of 52%, beginning in October of 2007 through March of 2009. So the really interesting thing about this chart is when you compare the size and duration of the advances and declines. The advances range from a low of 48% increases beginning in October of 66 through November of 68, and the high increase of 267% over 7+ years from June 1949 to August 1956. If your time horizon is more than just a few years, and I've kind of gone over that most people it is, we think the deck is clearly stacked in favor of advances rather than declines. It pays off to stay invested if you're hoping to grow and preserve your wealth and that purchasing power. So enough economy talk. I'm happy to send this chart if you'd like. Just shoot me an email or ask in our next meeting, and I'll get this chart out to you. I think it's one of the most important charts you can see at this point in time. So I'm going to pass the mic over to Peter to talk about our investment process now. Peter?
Thanks, Justin. Very often, our clients will ask us, where do you get your ideas? So we thought we'd share that with you today. There's really three main sources that we turn to when we're gathering information about companies. In no particular order, they are the media, professional research subscriptions, and other value managers. From the media standpoint, our three primary sources are two newspapers and one financial website. We receive Barron's, which is a weekly subscription, and the Wall Street Journal, which is delivered to us daily. And then finally, Yahoo Finance, which is an extremely helpful website in finding information and other news on various companies and financial topics. These sources that are used primarily to utilize awareness, and when we want to gain greater insight, we turn to professional research. Now, there's a lot of terrific information out there, and we've listed our main sources as Guru Focus, Morningstar, Seeking Alpha, Value Line, and Standard & Poor's. These are all subscription services that offer reports and opinions and give us the ability to look at various investment managers and research to companies. We pay for most of these services, but a few of these are available at no cost. Now, another great source of in-depth information are releases from the companies themselves. We have an opportunity to read companies' reports such as the 10K and annual reports, and those are issued throughout the year, as well as listening in on their quarterly conference calls with the management teams. And this is clearly one of the great sources of information for being intimately familiar with the companies that we own. Another outstanding source of information is other like-minded individuals. And while there are literally thousands of investment analysts, our team has selected several value managers, and we follow their work and study their portfolios to gain insight and understanding. And this helps us to develop our own value approach that we follow. So among the investment managers that we hold in high regard are individuals such as Warren Buffett, who may well be considered the greatest capital allocator of all time. Marty Whitman, who is a legend in his own right in the value investment arena. John Spears of Tweedy Brown, Mason Hawkins from Southeastern Asset Management, Bruce Berkowitz from Fairholme Capital, and finally Howard Marks from Oak Tree Capital Management. So we find these individuals to be like-minded. We've read their books. We look for their articles. We pay attention to the investments they own. So now I'd like to turn it back to Justin for an update on the recent changes to the newest federal budget. Justin?
So this quarter we have a financial planning highlight to share with you. It may not necessarily pertain to everyone on this call or everybody who listens to this call, but it's important enough to share with everyone. The big news last week is that Congress finally passed the new budget. The Bipartisan Budget Act of 2015 was signed into law on November 2nd, 2015, and provides legislation to raise the federal debt limit and establishes a framework for a 2-year budget deal. While the passing of this budget has received a lot of media attention, mainly because Congress finally agreed to something, we feel that the media has not given enough attention to two areas that seriously matter to you. First being the serious reduction to the proposed increases to your Medicare Part B premiums, and the second being the amendments to Social Security filing strategies. Now, if you're under the age of 62, it's unlikely that these matter to you, but given that many of our clients are eligible for these two programs, we felt it necessary to spend some time discussing what these changes mean to you. I'll start with Medicare. Medicare, as you might know, is a program that provides healthcare benefits to eligible members over the age of 65. Prior to this budget passing, there were some serious increases in the cost of premiums that would have impacted many of you. The good news is that we will not be experiencing these severe increases, which could have impacted some with rate increases as high as 52%. So instead of a 52% increase affecting millions of Americans, it's only going to be about a 15% increase this year. So that's some good news coming out of Congress. And the other good news is that most of you are probably in a program called the Safe Harbor, and will not be affected by this 15% increase at all. This all means dramatically lower costs, and that is great news for Medicare Part B, in our opinion. So on to Social Security. I started with the good news. I'm ending with the bad. Congress has caught on to two popular financial planning loopholes that pertain to married couples filing for Social Security. They are called the file and suspend strategy and the restricted application. I'm not going to get into the nitty-gritty details here of what these two programs are, but there's one thing you need to be aware of. If you are within 6 months of your full retirement age, or 66 years old, then you have an opportunity to be grandfathered into these strategies, and it might make a lot of sense for you to pursue one of them. If you fall into this camp, let's talk soon so that we can run projections on the impact of these filing strategies, because you only have 6 months to figure it out before it's too late. If you're most people and don't fall into that camp, just know that you now have less strategic options for filing for Social Security benefits. I'm happy to send over a quick 2-page article that summarizes these changes. Just send me an email or stay on at the end of the call and ask, and I'll get that document out to whoever's interested.
So now we're going to shift gears and talk about some of the specific companies that we own. So let me start with an overview. During recent weeks, the majority of companies that we own and recommend have been releasing their third quarter earnings. In addition to these earnings reports, we've also had the opportunity to listen to the management, and we'd like to share some of our learnings with you on the reports and the calls with you today. Earlier in the call, I mentioned that tuning into the information released by the companies in your portfolios is often the best way to become intimately familiar with the business. We have in the past 2 weeks on these calls provides our team with both confidence in the investments that we own. So in hearing the chief executive officers and chief financial officers speak about their business and respond to questions instills a sense of confidence in the stewardship they have as managers of your money. All the companies that we'll be discussing, we plan to continue to own for the long term and are significant holdings in many of our clients' portfolios. I would also be comfortable in adding to these positions at current prices. While we are excited about many of the other companies in our portfolio, we've chosen to limit our discussion today to just 4 of our holdings. The first one I'd like to talk about is Lowe's Corporation. So on November 2nd, Lowe's Corp released their earnings, and later in the day I had the opportunity to listen to the president and CEO and also director James Tisch. Lowe's is a diversified company with 3 publicly traded subsidiaries. The first is Diamond Offshore Drilling, the second is Boardwalk Pipeline Partners, and the third is CNA Financial. As well as they have one wholly owned subsidiary, Lowe's Hotels and Resorts. During 2015, Lowe's shares have performed poorly due to the following 3 challenging market conditions. 1, the steep drop in energy prices. 2, the reduction in oil company production and exploration budgets. And 3, a wave of new oil rig deliveries that began about 6 years ago. These conditions have caused drilling contracts to be shortened, canceled, or renegotiated, resulting in rigs being idle. Additionally, oil companies have deferred or canceled new drilling projects, even with day rates at less than half of their peak levels. These circumstances have created a very difficult environment in the offshore drilling industry, to say the least. The decline, which we believe is temporary, has resulted in the market undervaluing Lowe's shares as well as their subsidiaries. Despite being frustrated by the price, rather than complain, Lowe's management has looked at this as an opportunity to create shareholder value by buying back their stock. They were happy to buy back 8.7 million shares during the third quarter, and year to date they have spent over $750 million buying back over 19 million shares. We believe this to be an outstanding allocation of capital and fully support the directives of Lowe's management team.
Thanks, Peter. Next, we had the opportunity on October 28th to read through the third quarter results for Hersha Hospitality Trust. Hersha is a self-advised real estate investment trust which owns and operates high-quality, upscale hotels in urban markets. Right now, the company's 53 hotels are located in cities like New York, Boston, Philadelphia, Washington, D.C., Miami, and they have some select markets on the West Coast. During the last several years, Hersha has made a concerted effort to realign their portfolio by acquiring a number of high-quality assets, and they're also renovating a majority of their existing properties. The company performed exceedingly well during the quarter with occupancy rates of over 87%, and they continue to increase the revenues per available room in each of their hotel properties. The company is in extremely strong financial shape. They have $29 million in cash and equivalents, a fully undrawn $250 million line of credit, and in August, they closed on a $300 million unsecured term loan. All this means is that the company has significant financial strength, which will allow them to acquire additional properties, buy back shares in the company, and upgrade their existing properties. So let me talk for a few minutes on the acquisition front. During the third quarter, the company acquired a 94-room Town Place Suites in Sunnyvale, California for $27.7 million. This acquisition was Hersha's third extended stay property in Northern California and marks the company's entry into the heart of Silicon Valley. The company also signed a purchase and sale agreement for the 60-room Sanctuary Beach Resort in Monterey Beach, California for $39.5 million. This resort sits on a 13.2 beachfront acreages, and the management believes this property has significant potential. Management also took advantage of the significant discount to the net asset value of the company by repurchasing 3.7 million common shares of stock for $91.8 million. That represents a 7.5% repurchase of the common shares outstanding as of the end of 2014. In October, Hersha's board authorized a new share repurchase program of up to $100 million of the company's outstanding stock. Given the significant discount to what we believe the company to be worth, their net asset value, and the 4% dividend yield receive on the stock, we believe that Hersha is a wonderful company to continue to hold and to acquire at the current prices.
So on October 30th, Weyerhaeuser reported their third quarter earnings, and I had a chance to listen to Doyle Simons, President and Chief Executive, with his management team discuss the company's results. Since that October 30th call, the company on this Sunday announced they're going to merge with their large competitor, Plum Creek, and I had a chance to listen in on that conference call yesterday as well. Now, Weyerhaeuser is one of the world's largest owners of private timberlands, and they control nearly 7 million acres, primarily in the Pacific Northwest and the southeastern United States. The company continues to make significant improvements despite market and global economic headwinds. In addition, the company delivered an ongoing commitment to return cash to shareholders by increasing its quarterly dividend by 7% and completing the $700 million share repurchase authorized in 2014. As I discussed earlier, the company continues to experience headwinds as the U.S. housing market recovers from the downturn it experienced, as well as a slowdown in shipments to China. Doyle Simons continues to act as a steward to shareholders by reducing costs, selling non-core assets, and improving operations. With the company's 4% dividend and a significant discount to its net asset value, we continue to feel excited about the long-term opportunity as Weyerhaeuser shareholders. And in addition to that, we get more information on the merger, but on my first view of it, we're very supportive of the direction they're taking and believe that they're acquiring additional acreage at significant discounts relative to private market transactions. Justin?
All right, we'll wrap up with one of our favorites. I'm sure everyone has heard us talk about this often if you've worked with us for any period of time. On October 27th, Corning reported their third quarter results and announced several strategic and capital allocation plans through 2019. During the quarter, the weakening global economy, particularly in China, and the stronger US dollar impacted the global business, which was true for most global businesses. These headwinds caused profits to decline during the quarter and are expected to continue into the fourth quarter, but the long-term trends still remain positive. Chairman and CEO Wendell Weeks and his management team continue to act as stewards to our invested capital and laid out plans to return more than $10 billion to shareholders and to invest approximately $10 billion into Corning's core businesses. The plans to deliver on its $10 billion plan to shareholders involve increasing the company's share repurchase program and increasing dividends. As part of the plan, Corning intends to reduce its global cash to approximately $2 billion, and they're going to increase their debt. These changes we feel are positive and will provide the company with more opportunity to experience returns on the equity invested in their businesses. The company also plans to invest $10 billion into Corning's portfolio. Corning is going to concentrate on its research and development investment, their capital spending, as well as strategic mergers and acquisitions to improve on the three core technologies in glass, optical physics, and ceramics. We're encouraged by the long-term industry trends, particularly in the fact that customers want larger flat panel TVs and bandwidth that continues to grow. So these two factors will benefit Corning's major businesses. We continue to feel positive about Corning's long-term potential and that the management is committed to the stewardship of its investors' money. So with that, we're going to wrap up the recorded portion of this call, and I'll unmute the lines in just a second for our question and answer session. Thank you for tuning into the O'Keefe & Stevens team's fourth quarterly call for 2015. This concludes the November 10th, 2015 O'Keefe & Stevens quarterly update call. This call will be archived in our library and can be requested by emailing any member of the O'Keefe & Stevens team at Sage Ruddy.